Hello, welcome. My name is Tom Copeland. I'm an attorney, author, trainer, and advocate for the business of family childcare. In this video, we're going to talk about what is the best business structure for a childcare provider. What is a business structure? It's the legal entity under which you operate your business. And there are essentially four types of structures. You could be a sole proprietor, a partnership, a limited liability company, or a corporation. An S or C are the two types of corporations. Let's talk about these one at a time. Sole proprietor. Once you start your business, you're automatically a sole proprietor. This is also known as being self-employed. You don't need to register or file any forms. You just are a self-employed person. What does this mean? You keep all the profits, you make all the decisions. You're in charge. You're personally liable for any accident that occurs, and you can hire employees if you want. Second type of structure, a partnership. Partnership is formed when two or more people run a business together. Now, in this case, you must file a partnership agreement with the state. You must officially establish a partnership. It could be between a mother and a daughter, two friends, a husband and a wife. Each partner is liable for the actions of the other. So you take on more risks when you're in a partnership. The other person does something, you are responsible for whatever that other partner does. The profits and decision-making are shared. But an informal partnership is not allowed. This is where I think I see the most problems here. Two people decide, well, let's just work together. We were friends or relatives. We'll run it out of one of our homes and we'll just kind of divide up the income and expenses. No, you can't do that. You have to officially form a partnership. If you don't, and you get audited, the IRS will determine either that one of you is the owner and you must be taxed that way, or they might decide you have to be set up some in a different form. And this is, no, you cannot just informally get together. You either have to structure it as a partnership. And when I look at these situations, I usually say it's simpler to have one person be the owner, the self-employed person, and hire the other person. That's usually simpler all the way around. A limited liability company. It's a type of corporation, but that is less complicated than the S or C corporation. Again, you got to file paperwork to get incorporated. You may get some personal liability limited. You may be able to limit some of your personal liability. Now, LLCs are a little complicated. You can form a a single person LLC that's just you. You can create a partnership LLC or a corporate LLC. But the vast majority of providers who set up an LLC do it as a one-person LLC. And that's because it's taxed exactly like a sole proprietor. It's simpler. There's no tax savings for setting up an LLC, but there's no tax complications. Last type of structure, corporation. It's the most complicated. You got to file paperwork to incorporate under your state laws. You would go to your Secretary of State's office to file as a partnership, an LLC, or a corporation. They'll give you the forms to fill out to do this. Now, a corporation is owned by the shareholders. You don't own it. You can be one of the shareholders, your spouse, somebody else, but you've got other people now involved in the ownership. If you have a C corporation, the benefit there is you can set up some tax-free employee benefits. As a corporation, you would be an employee. And then the corporation could pay for health care, pay for other benefits, and deduct it. If you're an S corporation, the corporate profits are only taxed once. This gets complicated, and I don't want to go into the details, but the two types of corporations, you would need to look at which makes most sense in your situation. All right, so that's a rough run-through of these options. Well, what should you choose? This decision is complicated, although in my opinion, there's a simple answer for the vast majority of people. I think there are 5 things you should look at before making this decision. There's the complication of record keeping. There are fees, in other words, paying fees. Corporations and partnerships have to pay fees, sole proprietors don't. Who has control of the business? Who's in charge? How much taxes are you going to pay? Is there any tax savings for one structure versus another? And how do you limit your personal liability? Can you do it through one of these structures? So, now let's get down to it. Which structure is best? If you're a sole proprietor, the record keeping is simpler. All other options are more complicated. Why? When you're a self-employed person, you can have one bank account. You can lump all your income together and pay out expenses out of any bank account that you want. It doesn't matter. But if you form a corporation, partnership, or LLC, you need to keep your business and personal records separate. And this is where I think is a major problem. So if you're a corporation or partnership, you got to have a separate business bank account. Right? That's not a big deal. You deposit all your business income into that account. Okay, that's not a big deal. But you can't commingle funds. So you could write a check out of your business account for something that's 100% business, some toys, great. But what about paying for cleaning supplies or furniture or something else that's business and personal? If you write that check out of your business account, you've commingled funds because part of that's personal. And then you would lose any personal liability protection. Instead, you'd have to write a shared expense out of your personal account and then reimburse from the business account. The business account can deduct the business portion of that expense. What is the business portion of that shared expense? It's your time and space percent. Well, what is that? You need to figure that out at the end of the year. So now at the end of the year, you got all these calculations. Okay, I get 40% of this and 40% of that and so on. It's a headache. Sole proprietor does not have annual fees. Corporations have to pay to the state fees every year. Control of business. When you're self-employed, sole proprietor, you're in charge. You make all the decisions. Now, it's possible that with an S or C corporation, you might save some money on taxes. And usually that can occur if you're making a larger profit, like more than $30,000, $40,000 up there profit. Then it's possible that you could see some tax savings. And you can get some limited personal liability protection. Well, let's talk about this personal liability. The general idea of a corporation is that it protects your personal assets from a lawsuit, but not your business assets. So, let's say you're incorporated, and there's a terrible accident, a child is seriously injured, and a parent is suing you for $50,000, $100,000, $1 million. Well, if you're incorporated, the idea is they can't come after your personal stuff. They can only come after your business stuff, meaning the money in your business bank account, your business equipment. All right? Well, this is not so simple because you're doing childcare out of your home. Your home is a business and personal asset. So they could come after the business portion of your home, which is the time-space percentage. So if your time-space percentage is 40%, they could reasonably sue you for 40% of the value of your home and all the shared furniture, appliances, and so on. So it's not so clear that you're getting the kind of protection that you think you might be getting. Incorporation is no substitute for purchasing business liability insurance. You always need business liability insurance. That's what really protects you in the case of a major lawsuit. It's not the fact that you might be incorporated. Incorporation doesn't eliminate all personal liability. If you're negligent, your incorporation is not going to protect you. If you need to pay for a lawyer, parent sues you, okay, you need to hire a lawyer to defend you. If you're incorporated, you still need to pay your lawyer. So that's not, that's not the safety, the assurance that you don't have to worry about things just because you're incorporated. If you're an LLC, it's not as clear that you're going to get the kind of personal liability protection that you might for an S or C corporation, so I'd be a little bit nervous about that. An S or C corporation will protect your personal assets, but again, what are your personal assets? So, in my opinion, sole proprietor, that's the best business structure, and I would say it's the best for like 95+% of providers. If you're thinking about incorporating, you need to be able to say to yourself, I'm going to be in business for quite a while to take advantage of the corporation. I don't mind doing a lot of record keeping. And you need to get a lot of liability insurance as well. And you're making a bunch of money, you know, 30, 40, 50 plus $1,000 profit every year. If you're not comfortable with all that, then don't even think about it. You're going to be fine by being sole proprietor and having a lot of business liability insurance. So, if you're thinking about something besides being sole proprietor, you need to talk to a lawyer and a tax preparer. Why? A lawyer can give you legal advice about the consequences of incorporating and which one to choose, but they don't necessarily understand the tax consequences. A tax preparer can tell you about the tax consequences of these options, but is not going to give you good advice about the legal consequences. So you need both to give you the best advice. Liability protection, which is the main reason people incorporate, can be lost if you're not following all the corporate formalities. I've talked about the issue of separate record keeping, but also corporations, you may have to have board meetings and keeping minutes of board meetings and putting your business name, your corporate name on every single document. If you don't, that would lose your liability protection. There's a lot of formalities. So it's a headache for most people. If you have questions after listening to this, feel free to give me a call, send me an email. My email address is here. I don't charge anything for answering questions. Or visit my website. I've written more about this issue of business structures there. So good luck. I'm not providing you with tax, legal, or professional advice. You need to seek that out on this topic. This video was funded by the Child Care Communications Management Center, which is funded by the Office of Child Care, the Administration for Children and Families, the U.S. Department of Health and Human Services, and was developed in partnership with the National Center on Early Childhood Quality Assurance, which is funded by the OCC, the Office of Head Start, ACF, and HHS. This video can be duplicated for non-commercial purposes, and you don't need permission. So thanks very much for listening.